Thank you, sir. Hello, guys. Welcome back to BOS live learning classes. Again, that the topic that we have for today is transfer pricing. So if you guys remember, we discussed in the last lecture the basics relating to transfer pricing. And for today, we have a different agenda altogether, which is on transfer pricing methods. As usual, the rules remain the same. If you have any doubts, I'm going to take those doubts as along with that particular topic. So even today, if you have any doubts relating to a particular topic, please drop your questions, onto the, portal, the chat box there, and I'll take your questions as and when I take you through those particular topics. If you have any questions from the last lecture, please let me know those also. So I'll take them, take those particular lectures also. Otherwise, we will just start with what we have for today. So as just a recapitulation to what we did in the last lecture, we started with, the need to transfer pricing. What exactly is the concept relating to transfer pricing? So, there was a lot of tax avoidance strategies as we discussed were happening. If you guys remember, we were discussing this case study on which profits were actually moving from a high tax jurisdiction to a low tax jurisdiction by multinational enterprises. And so as to curb these tax avoidance strategies, the CBDT came up with something called transfer pricing laws, transfer pricing rules that basically make sure that, if two related parties or two associated entities are transacting with each other, they should transact at something called the arm's length price. So this is what we discussed in the last lecture. Also, what we discussed was, if you remember, we discussed the meaning of associated enterprises. It was provided in section 92A and subsection 1 and subsection 2. And after that, we discussed this concept around international transaction. So the point is that, the moment you know that one, there are two entities and they are associated to each other. You have to find out that by virtue of section 92A. Then the second step is to find out whether there is an international transaction or not. That is by virtue of section 92B of the Income Tax Act 1961. And then it could be a deemed international transaction also that you have to see side by side. If these two conditions are satisfied, then you will have to make sure that entities are transacting at something called arm's length price. That basically means that you'll have to see what exactly are independent enterprises transacting at, and then you'll have to make sure that related parties also transact at the same arm's length price. So that is what we discussed in the last lecture. What we have for today is this. This is the plan that we have for today. So now the point is that, okay, you've been talking about what exactly is, the arm's length price, and, that related parties have to transact at something called arm's length price. But the point is, how do you calculate this arm's length price? So then we have 5 methods out there on how to calculate arm's length price. These are the 5 methods. I'm going to talk about these 5 methods today. And then India has a 6th method also. So internationally, there are 5 methods. And India has one more method, which is called the other method. So these are the 6 methods that we will be talking about today. And then we will be talking about that how do you, out of these 5 methods, how do you know that, in which situation, which method will actually come into play. So that is selection of the most appropriate method. And then finally, I'm going to talk about something called benchmarking analysis. What I'll do is I will actually convert these methods and I will tell you how these methods are used practically. If you have a client assignment that is dealing with transfer pricing situations, how do you deal with those methods in a practical scenario? That is something called benchmarking analysis. That basically means finding out comparable companies. But before that, I need to explain what exactly are comparable companies, why are we finding comparable companies, etc. So we'll take it, step by step today. So that is really the plan, for today. Also, I want to tell you that I have uploaded the PPT onto the portal. So if you have, if you want to revise through, please use the PPT because, it will just help you. Even if you're making notes, I'd just like to tell you that if you, go through the PPT and read it in sync with the ICAI study manual, it will just, everything will make sense. So, listen to what I'm saying, and if you like writing and taking down notes, well and good, but you can make use of the PPT also that I've uploaded on the portal. So shall we start for today? Any questions before that? Yes, there is a question on the portal which says deemed AE conditions are to be checked every year. Yes, that's absolutely correct. You have to check, AE conditions every year, because as we were discussing in the last lecture, the law says that it is every year that you have to check. Maybe two enterprises are holding 13% share capital in year one, but then in year two they are holding 27% share capital. So that basically means that year one they were not related, and year two they got actually related. So you have to check, AE conditions and all the AE deemed AE instances which are provided in section 92A subsection 2. You have to check it year on year basis, because it might just change year on year basis. So yes, you have to do that every year. Any other question? Or we can just start. Okay, great. Let's start for today. So what we have for today is just a slide which is summarizing what we did last lecture. We did what exactly was the arm's length price. So if you look at section 92F, it basically says that, arm's length price is a price that you apply in situations which is between persons other than AEs. That basically means that, arm's length price is basically the price at which independent enterprises are transacting at. But then at the same time, it is very, very important to make sure that, if you're replicating the price that independent enterprises are transacting at, then you'll have to make sure that every condition relating to that particular transaction is the same. So meaning to say that, if you look at, this was the chart that we were discussing then, in the last lecture. So if you say in this particular situation that 80 is not the arm's length price should have been 120, and even related parties should not have transacted at 80. They should have also transacted at 120, because independent parties are doing that. Then you'll have to make sure that all the comparability conditions should be the same, and you are able to compare these two conditions. What are these comparability conditions? Well, these are things like nature of the product. You have to compare a pencil to a pencil, and you have to compare a pen to a pen. You cannot do it otherwise. Then the time frame should be the same, etc., etc. So today we will be discussing what exactly are these conditions and where are they exactly put. They are provided in the Income Tax Act itself. So we'll read through those particular conditions, But this is what you need to make sure if you need to follow something called the arm's length price. So this is what we were discussing in the last lecture. Now, in today's lecture, we will be discussing how to determine the arm's length price. That is, that is going to form the basis of today's lecture, and we'll be spending about more than 2 hours just discussing how do you determine this arm's length price. So if you look at the manner of determination of arm's length price, there are several transfer pricing methods available out there. So there are these methods available by which you actually calculate the arm's length price. So as I mentioned before, if you look internationally, if you look at international guidelines, if you look at OECD transfer pricing guidelines, and there are these UN transfer pricing guidelines also. One is given by the OECD, one is given by UN, and everyone, all the nations around the world, they follow these particular guidelines. If you look at these particular guidelines, they recommend 5 methods by which you can calculate something called the arm's length price. However, if you look at section 92C of the Income Tax Act, they've given 6 methods out there. So they've adopted those 5 methods which were given internationally, plus they have adopted another method which is called other method. We have other method also in India. So the point is that isn't this very confusing? I mean, how do you make sure that which method to apply in which particular circumstance? I mean, out of 6 methods, how do you choose that, this method should be useful and this method is not for our client case, or, for the not for our examination purposes, not for our case study, etc. Well, you have to choose a method, they say, which is dependent on the facts and circumstances of each situation. And going forward, I'll tell you how to choose these particular methods also. But I'm really trying to tell you is that never it's going to happen that one single method will be considered suitable in all situations. That's not going to happen. You have to select a method which is dependent on the facts and circumstances of that particular transaction in question. So all the methods, they rely either on something called price, or they're talking about profit margins, etc. So you will have to see which is best suited to your facts and circumstances. And hence the terminology that transfer pricing laws actually use so as to see which method is suitable, they call it most appropriate method, MAM. That basically means what is the method which is most appropriate to your facts and circumstances that is going to be adopted by in that particular question or in that particular case study or by the client. So it's just dependent on facts and circumstances, and it's called the most appropriate method. So in this particular slide, I'm just trying to tell you that there are so many methods available, 6 methods in India, 5 methods internationally, but you'll have to see what method is most appropriate to your circumstances and then use that particular method. So, the point is, what exactly are these transfer pricing methods? Well, the transfer pricing methods are these. So I've just made a table out of what exactly are these transfer pricing methods. So if you look at these particular methods, they are divided into sort of two, units. One is called the traditional transaction methods, and the second is called the transactional profit method. Traditional transaction methods, they are, more dealing with price. They are very, very simple and very, very direct methods. However, if you look at transactional profit methods, the name suggests profit. So they basically deal with margins in that particular instance. If you look at traditional transaction methods, there are 3 kinds: comparable uncontrolled price method, resale price method, and cost plus method. So if you look at, the 3 traditional methods or the traditional transaction methods, they're somehow dealing with price. If you look at this method, it deals with the price, resale price. Even here, it is the cost price or cost plus method. So these 3 deal with something called the price situation. They are called traditional transaction methods. And you will have to, right now it might just sound very, overwhelming to understand these 3 methods. But now going forward, we'll be discussing these 3 methods in a lot of detail. So it's going to just come in handy with time. The second kind of methods are called the transactional profit methods. They're called profit methods. They are a little complex as compared to, traditional transaction methods. They're not as direct as traditional transaction methods. They somehow deal with something called the margin. So if you see here, it's going to deal with margin or the profit, transactional net margin method, TNMM. And then this is also dealing with profit. It is called the profit split method or the PSM. So these are the 5 methods that are there internationally in all the guidelines: the CUP, RPM, CPM, TNMM, and PSM. These are the 5 methods that are available internationally, but India has adopted a 6th method also, which is called other method. This is provided in Rule 10AB. We'll be discussing this also in a lot of detail. So these are the 6 methods that are provided in India. Whatever I explained, I've provided them here also, that, traditional transaction methods, they're very, very direct method. And, it's very easy to calculate ALP using these particular methods, because there are something called adjustments which are not required and they're not as complex as transactional profit methods. Going forward, I'm going to tell you what are these adjustments, and, you'll also realize that these are very, very direct methods. And then there are transactional profit methods. Whenever there is something very different, whenever there is something very unique, something, relating to intangible, something which is very difficult to establish, then we make use of the transactional profit methods, which is the TNMM and the PSM, profit split method. Now, there was a time in India and even internationally, they said that we have to follow a hierarchy of methods. They started to say that, listen, whenever you get a situation, whenever you get a client situation, or you get a case study in hand on which method to apply, what you do is use CUP first. If CUP doesn't work, then use RPM. If RPM doesn't work, use CPM. If CPM also doesn't work, use TNMM. If TNMM also doesn't work, then you use PSM. So there was a sort of hierarchy of methods. Use this first, this is second, this is third number, this is fourth number. But today, if you look at laws have changed tremendously, and they say that there is no hierarchy of methods. And hence, this is a very important question, and I've also highlighted this here. There is no hierarchy of methods in the Indian law or internationally, because now we have Rule 10C1, which basically says that you have to use a method which is best suited to your facts and circumstances, and that provides the most reliable measure of the arm's length price, which you feel that it is the best for your transaction, and there is no other method that is going to be suitable for your transaction. This concept is called the most appropriate method. So what I'm really trying to say is that there is no hierarchy that you follow. We don't have a 1, 2, 3, 4 kind of a situation. We don't prioritize any method over the other anymore, but we have something called the most appropriate method, MAM, which basically says that you just have to see your client situation, you just have to see your case study, and then whatever is the best suited to that particular case study, you will have to use that particular method, and that is called the most appropriate method. So going forward, as we take up one method individually, I'm going to tell you when is this method used, when is this method used. Maybe for manufacturers there is a particular method, maybe for traders there is a particular method, maybe there are different methods for each circumstances. So I'm going to tell you as and when we go through it. And what I've done is, in this particular slide, it says which method when. So I've summarized this also for you, which situation, which method is actually used. So you can make use of this particular slide towards the end also. But this slide will come into play when we've discussed all the methods that are there. So any questions here before we move to the first method, which is called the comparable uncontrolled price method? Or shall we move to CUP method? Any questions here? Okay, great. So the first method is comparable uncontrolled price method, which is also called the CUP method. Now, what we do in the CUP method, we'll come back to this particular slide. I've just put it for your reference. This is the CUP method. CUP method is very simple. It is called the most direct method. It is everyone's favorite method, and that is because it is very easy. In CUP method, they say that, listen, have you undertaken a transaction with your related party and now you're trying to find the ALP? Yes, this is what we're trying to do. They say that, listen, look for an independent party who's dealing with in the same product, who is dealing in the same market, who is dealing in the same country, who is dealing at the same time period. Look at what is the price that those independent parties are charging, and use that price. Just copy paste their price to your price, and that is going to be your arm's length price. So what CUP is really trying to say, the comparable uncontrolled price method, it's saying that the price which is charged in a controlled transaction is compared with the price which is charged in a comparable uncontrolled transaction, and you just replicate that particular price. Now, the thing is, what is an uncontrolled transaction? We did this, in the last lecture. Can you put it there? Can you put it in the chat box? What is an uncontrolled transaction? What is an uncontrolled transaction? Okay, I'll wait for this. What is an uncontrolled transaction? Exactly. Uncontrolled transaction. I've got a response there which says market forces decide the price. That basically means that uncontrolled transaction is the transaction between independent parties. When two random independent parties transact, that is called an uncontrolled transaction. It's provided in the slides there in the last lecture. So what COP does is that C for a comparable uncontrolled transaction means that look for an independent party transaction and that kind of transaction which is comparable to your transaction, and just see whatever is the price that they are charging, you also charge that particular price, and that is going to become your ALP. So that is the most direct method and it is preferred by tax authorities globally. Yes, I've got more responses which basically say transaction with independent entities. That is an uncontrolled transaction. And so in CUP, you adopt that price to your price. So in this particular situation, if we go back to this, situation, if we were applying CUP in this particular situation, then 80 is obviously not the ALP. The ALP in this particular situation would have been 120. And how 120? Well, that is because we have applied the CUP method, and CUP method says that look for an uncontrolled transaction given the fact that this is comparable. So you'll have to make sure that these two are comparable to each other, and then ALP would have been 120 in this particular situation also. So the point is that what exactly do you have to make sure that this is comparable and this is comparable? What are the factors that you have to make sure are comparable? Well, these are the comparability factors. So you'll have to make sure first that the type of the product is the same. When I say that the type of the product is the same, that means that you'll have to make sure that if your client or your related parties, they are manufacturing, say for example, a hair shampoo, then you'll have to make sure that the independent parties are also, manufacturing something called a hair shampoo. They are not manufacturing a conditioner or, a hair oil, etc. You have to compare a shampoo to a shampoo that ways. So this is the type of product. In another situation, as I mentioned before, a pencil has to be compared to a pencil. COP talks about something called strict comparability. When I say strict comparability, that means they're very, very strict when it comes to comparability. You cannot compare, say, for example, an ink pen to a ball pen. If you're talking about a ball pen, if you say that, your related party is actually manufacturing a ballpoint pen, then you'll have to make sure that these independent parties are also manufacturing a ballpoint pen. They are not manufacturing something called, an ink pen or, any other pen for that matter. So strict comparability has to be established. Then they say that the market levels have to be same. So if your related party is a manufacturer of, pens, then you will have to make sure that the independent parties are also manufacturer of pens. Isn't that obvious? No, it's not obvious, because a lot of time people compare a manufacturer to a distributor also. You cannot do that. So if your related party is manufacturing pens, then you will have to make sure that this independent party is also manufacturer of pens. It is not a distributor of pens that ways. So the type market levels have to be, the same that ways. Then there is something called geographical market. So if your related party is manufacturing in India, then you'll have to make sure that the independent parties that you're taking as ALP under CUP method, they are also manufacturing in India, because economic differences are there between countries. Maybe, some kind of manufacturing is cheaper in India and it is not very cheaper outside. So, that kind of difference will reflect. So you'll have to make sure that, the geographical market is the same. Then you'll have to make sure that the period of the transaction is the same. As I mentioned before in the last lecture, if you remember, the period of transaction, meant a situation which is pre-COVID and post-COVID. So if your entity is manufacturing post-COVID, then you have to make sure that the independent entity price is also post-COVID. You cannot compare post-COVID and pre-COVID, and that is because there were a lot of economic differences that happened in the economy because of this time period that we all went through. So geographical market is the same. That has to be taken into account. You cannot compare a situation of pre-recession to post-recession that ways. So that also makes a lot of difference. Then you'll have to make sure that economic conditions and contractual terms are also the same. When I mean contractual terms or economic conditions, it basically means that if your related party is a company which is this parent company for that matter, it is a company which has a turnover of 500 crores, then you cannot compare it to an independent party which has a turnover of 50 crores. That ways will also make a lot of difference. So you'll have to make sure that if your company is a big company earning a good amount of turnover of 500 crores, then you have to compare it with a similar level kind of an entity which is also earning a turnover of 500 crores. So this is what you have to make sure. So all these product comparabilities, all these factors will have to be taken into consideration when you are on a lookout to find out an independent party. What kind of independent party are you looking out for your CUP? Well, you'll have to make sure that these kind of situations are all established when you're looking out for another entity, another independent entity in the market. So that is what CUP actually looks at. Now I have two questions out here, and there are two questions I'm sure that are running your mind also. The point is that, the first question is, how do we find out independent entities? Like, do we just Google it, or is there a database out there that we can look around, or is there where do I find independent enterprises? I mean, I would, even if I am operating in an industry, I would know about my competitors, maybe two people in the industry or three people. How can I find that entire database? Well, that database is called a transfer pricing database. Those kind of databases where information of all the companies operating in India or operating in any other country are there. There are special databases for that, and these are called transfer pricing softwares or transfer pricing databases, etc. And what I'm going to do is talk about these databases also towards the end of the lecture. So I have screenshot of these particular databases. It's not there in the course, these screenshots, but I thought I'll give you a practical insight also on how we find comparable companies. So I'm going to come back to these particular slides towards the end now. So how do you find out these comparable companies? We'll discuss that. The second question that runs my mind is, you've talked about all these factors, and you said that there is strict comparability that is required, but this is very, very specific. What if I'm not able to find out a particular entity which is satisfying all these things? Maybe I'm able to find out maybe I'm able to find out all these things, but then one thing is absent, which is basically geographical market. So everything is satisfied, just so this one thing is not satisfied. What do I do then? Or maybe, like some one thing is not satisfied, otherwise everything is satisfied. Now, what do I do? Should I reject that particular comparable company? Should I just reject it because one thing is not, established? What should I do? Well, you can accept that company subject to something called adjustments. So are you able to adjust that particular, factor? If you're able to adjust that particular factor, then you can take that particular company. So what exactly are these adjustments? I'm going to talk about these adjustments. This is what is written in law, that you can take comparable uncontrolled transaction can be taken as CUP if the following conditions are met, which is none of the differences between the transaction being compared or the enterprise undertaking those transactions could materially affect the price in the open market, or reasonable accurate adjustments can be made to eliminate market effect of such differences. Meaning to say that if you feel that there is a difference between these two transactions and you really want to adopt this as the ALP, what you can do is make a reasonable adjustment and adjust that and then take this as the ALP. So this is what is provided in slide 10, which is the law out here, that you can make reasonable, accurate adjustments. And as long as you're able to make those adjustments and adopt that price, well and good, that will be your ALP or your arm's length price under the comparable uncontrolled price method. So as a quick revision, what exactly is this CUP method or comparable uncontrolled price method? Now you see, if you look at the meaning of if you look at the term also, it says uncontrolled price. That means the price which is coming from uncontrolled transactions. Which uncontrolled transaction? Well, independent enterprise transaction. And these are comparable transactions. So they are comparable in terms of the factors. Hence, this is called comparable uncontrolled price method. So they say that under this particular method, the price which is charged in comparable uncontrolled transaction will have to be identified, and this particular price can actually be taken. But they say that you might have to adjust it to differences. If there is any difference, then you'll have to make some reasonable, accurate adjustments. And then they say that the adjusted price will be considered as the arm's length price. So the point is that, what are these kind of adjustments are you talking about? Can you give us examples on these particular adjustments? Yes, this is the example. Adjustments. What adjustments are we really talking about? So let's take an example on this particular adjustment. But any question before this? Well, this is a very common question. I have a question on the portal which says, if no such comparison is available, then how it has to be done? Well, if you're not able to have a comparable company, if you're not able to find out an independent enterprise, then you do not use CUP. You'd use some other method then. So you have to cancel out this particular method in that particular instance. You have to use some other method. This method will be applicable only if you can find a comparable company. If you can, we call these companies as comparable companies. And we also, sometimes we also call them comparables. It basically means, are you able to find out an independent enterprise or an independent company which is comparable to you? Then you use CUP. If you're not able to find it out, then you cancel out CUP method and you use some other method. I'm going to talk about other methods also going forward. So then, you can make that choice. But any questions? If there are no questions, then I'm going to explain what exactly are these adjustments. Okay. So now the adjustment is, we take an example to discuss what exactly are these adjustments. Let's take an example. Let's say there is some A Limited company. This A Limited is in India. Now, A Limited is in the process of selling of metal. And for selling of metal, they need to purchase some crude metal. They need to purchase some raw materials. Now, they have two options out here. They purchase raw material from B Limited. B Limited is in USA and they are associated to each other. So A Limited is associated to B Limited. When they purchase raw material from B Limited, they charge, B Limited, they purchase it from B Limited at 30,000 rupees per MT. But if they have another entity out there, which is C Limited, that is also in USA and that is not related to them. So when they actually purchase raw material from C Limited, they purchase it at 40,000 rupees. So if you see, this is not correct, because when they purchase it from, non-related party, they purchase it at 40,000 rupees. But when they purchase it from their associated enterprise, they purchase it at 30,000 rupees. So that is absolutely not correct. And that basically gives us a clue that 30,000 is not the arm's length price. So the point is, what exactly is the arm's length price? And that is what we need to find out in this particular situation. So the question further says that A Limited receives a discount of 500 per MT as quantity discount from B Limited. So that basically means that if they're purchasing from B Limited, they also on 30,000, they also get a quantity discount. So the point is that we know that 30,000 is not the ALP. The point is, what is the ALP? So now we understand that, listen, we can actually use an independent party. There is an independent party out there, and we can use their price as the arm's length price under the CUP method, because CUP method says that, you have to find a comparable uncontrolled price. The comparable uncontrolled price here is 40,000 rupees. But the point is, can we use 40,000 rupees? Yes, we can use 40,000 rupees, because if you see, both are from USA, and both are purchasing the same crude metal oil. They're selling to the same entity. Everything is met. All the product comparability, the strict product comparability, etc., is met. So we can use 40,000 rupees as the ALP. But then when we use 40,000 rupees at the ALP, we realize that there should be an adjustment to be made, because they are offering B Limited a quantity discount, and they're not offering that quantity discount to C Limited. So we can use this price as 40,000 rupees as ALP, but then we'll have to adjust it to also give them a quantity discount. So that basically means that ALP should be 40,000 rupees, but we'll have to adjust it and make it similar to what related party situation is doing. So they are offering a quantity discount of 500. So ALP will be 40,000 rupees, what independent parties are doing, minus the adjustment that we need to make. Minus, we'll also provide a quantity discount of 500. So ALP is 39,500 rupees in this particular situation. That basically means that in this situation, in a related party situation between A Limited and B Limited, you shouldn't have charged them 30,000 rupees. You should have charged them 39,500 rupees, because that was the open market price, or that was the arm's length price. And we've done that using CUP method, because we knew that there was a comparable company, which is C Limited, available. So meaning to say that there will be an adjustment of 9,500, because you've already charged them 30,000 rupees, but you should have charged them 39,500 rupees. So tax authorities will have an adjustment, will make an adjustment of 9,500 rupees in this particular situation. So what I'm really trying to say is that this is how you basically adjust a CUP to your facts and circumstances. But this situation was possible only because we had a comparable company available. And we knew that, we can actually adjust, because this is a very small difference, or, like a very small, adjustment to make, which is on quantity discount. We can make it and, make an adjustment and use this price as, the ALP. But for that, we'll have to make an adjustment. Similar kind of adjustments happen a lot. So, this is for quantity discount. Then there are credit period adjustments also that are available. So, where the credit period is actually different, or, there are so many kind of quantity discounts. There are so many kind of adjustments. We'll read about that in the next, question. But these are really the kind of adjustments that we actually do in CUP method. Any questions here? So if you need to solve a question from an examination point of view, if you need to solve a question relating to CUP, what you have to do is the starting point should be independent party, situation. So in this situation also, the starting point of solving a CUP question is to take the independent entity price. In this also, we took the independent entity price, which was 40,000 rupees. And then we adjusted it to, all the adjustments that were provided in the question. So whenever there is a question relating to CUP, starting point should be the comparable uncontrolled price, or the independent party price, and then you adjust it accordingly. Okay, let's go on to the second question, which is this. Please take 1 minute to read through this particular question, and then we'll solve it together. and then I'm going to explain it. Please take 1 minute to read through the question. So let's go back to this particular, question. But before that, there's a question which says, from Indian point of view, from Indian tax, purchase at lesser price will increase the income chargeable to tax. That is, does it require ALP comparison? Well, there are two aspects to it. ALP comparison will be required. You will have to, in any case, substantiate that this was at ALP. But then, if at any point the income chargeable to tax is more than, as long as you're able to establish that income chargeable to tax is more than the competitors, then it's absolutely fine. So I think it's best to actually substantiate it by any point, substantiate it using any other method. If you somehow feel that the income chargeable to tax is greater than all the competitors, then you don't have to do anything. Then that is considered to be at ALP. So long as you're not able to, you're not basically avoiding payment of tax, ALP comparison then is absolutely fine. But then you'll have to see, sometimes we actually get, from a practical standpoint, we actually get, clients who are basically part of the same multinational group. So then you have to actually look at, both sides of the situation and then make a decision accordingly. So in this particular question, it says there is a US Limited. It is a US company and it has a subsidiary in India, which is called IND Limited. Now, US Limited sells computer monitors to IND Limited. That means it is selling to, the Indian company, and they are this particular US entity. It is also selling monitors or computer monitors to CMI Limited. This is also an Indian company, but this is not related to it. So meaning to say that there is a US entity. It is selling to a related party, which is, its own subsidiary, and it is selling to an unrelated party. So AE situation and non-AE situation. When it comes to the AE situation, it sells 50,000 computer monitors to IND Limited, and this is at 11,000 rupees per unit. But then when it is selling to, CMI Limited, it is at 10,000 rupees per unit. So step one of the situation, are they related? Yes, they are related to each other. Second situation is the transaction that they're talking about, an international transaction. As per section 92B, yes, it is an international transaction, meaning to say that transfer pricing provisions will apply. Now you see, is there a problem in this particular transaction? If they are, purchasing, Indian entity is purchasing at 11,000 rupees, which is, the related party is purchasing at 11,000 rupees, and non-related parties purchasing at 10,000 rupees. That means that this is not at ALP. Why? Because, the purchase price in AE situation is greater and the purchase price in non-AE situation is lesser. That basically means that in AE situation, the profits will be lesser, but in non-AE situation, the profits are more. So that basically means that what you're trying to avoid taxes by actually having a higher purchase price. Maybe that was the case. So you can, in this particular situation, use CUP. How will you use CUP? Well, you will use CUP by using CMI Limited, because they are also selling to another entity. They are selling the same computers, etc. So you can take 10,000 rupees as the ALP. But the question further says that warranty in case of sale of monitors to Unlimited is handled by Unlimited. However, for sale of monitors by CMI Limited, US Limited is responsible for the warranty of 3 months. So that basically means that everything is the same. You can take 10,000 rupees as the CUP, but the problem is that there is a warranty. This issue is not the same. Well, can you make an adjustment for that? Well, yes, we will try to make an adjustment. Let's see how we can. Both US and Limited and Unlimited offer extended warranty at a standard price of 1,000 per annum. On these facts, how is the assessment of Ind Limited going to be affected? Now, look at the question. It's not just asking you the ALP. It is also asking you that what will be the adjustment, what will be the assessment. That basically means that you just don't have to calculate the ALP. You'll also have to see that if tax authorities were to make an adjustment, because this is not a ALP, what is the adjustment that they will be actually making? So let's see what adjustment. Well, how is a CUP question to be dealt with? You start with the comparable uncontrolled price. In this situation, what is the comparable uncontrolled price, as in the price which is charged by independent parties? Well, it is 10,000 rupees. So what you do is you start with 10,000 rupees. And now we'll have to make adjustment. Well, the first adjustment that we'll make is of the cost of warranty. Well, the cost of warranty is 1,000 rupees, and it is we'll have to adjust this cost of warranty. So less cost of warranty, which is 1,000 rupees, and this is only for 3 months. So multiplied by 3 divided by 12 to make it, for 3 months, it's going to be 250 rupees. So arm's length price should have been 9750, but they were charging a related party 11,000 rupees. So that basically means that arm's length price was 9750. You should have charged 9750. But the problem is that you charged them 11,000 rupees. That means the difference per unit is 1250. And when the tax authorities see this, they will add 1250 to this particular situation, so as to actually make it, they will lessen 1250 so as to make it at arm's length price. But you'll have to find out what is the amount for the entire transaction. So 1250, multiply it by 50,000 computer monitors. So it is going to be 6 crore 25 lakh. That will be the addition that will actually be required. And this addition will be required because your transaction with the client, or the client transaction, or the related party situation was not at arm's length price. So this is how you actually deal with a question relating to CUP. You start with the comparable uncontrolled price and then make the adjustment. Look at the difference, if there is any difference, and then adjust it with multiplied by the number of units, and that is the total adjustment or the addition that will be made by the tax authorities, and that is how you answer a particular question. There is a question on the chat, which says, isn't it easier to move black money by over invoicing? Well, you cannot do that, because even over invoicing, maybe it is good for this particular jurisdiction, but the other jurisdiction, there will be a transfer pricing adjustment. So, when transfer pricing cases are handled, the multinationals actually look at both sides of the situation, and then they will, deal with it. So you'll have to look at both sides of the situation and then take a decision accordingly. So a multinational enterprise, even if they're secured in India, maybe that is not, if they have a parent entity in USA, they're not secured there. So there will be adjustment there. So what I'm really trying to say is that there will be adjustment either or situation. And if you look at a group, it's not solved. And hence these situations arise. Hence transfer pricing targets, these kind of situations that ways. Now, when it comes to CUP, there are two kinds of comparables that you're actually, that you can actually take. The two kind of CUPs or the two kind of comparables that you can take are internal CUPs or external CUPs, internal comparables or external comparables. The point is, what are internal comparables and what are external comparables? Internal comparable is a situation, like this. This is a situation for internal comparables. Um, there was a question here that in your example, you were talking about purchase at 30,000, which is less than 40,000, resulting in increase in profit. But if you look at this is an Indian entity that we're talking about. So if we're looking at it from an Indian entity's perspective, the question really reverses. And hence you'll have to make sure that for this Indian entity, it is at ALP. Sorry, I'm trying to answer a specific question on the chat box right now. But let's come back to internal CUPs and external CUPs. Internal CUP is when you have a similar transaction with unrelated parties as is done with the related party. An external CUP is when there are independent enterprises transaction which is taking place. This is very confusing right now, but I have two examples which will make internal CUP and external CUP very, very clear to you guys. The question is that, why are we differentiating between internal CUPs and external CUPs? Well, that is because internal CUP, internal comparables are preferred over external comparables. And how is that? You'll get to know when we discuss the examples. Let's take this example. This talks about internal comparables. What exactly are internal comparables? Well, let's take this situation. We have our client, which is I company here. Now, I company is actually selling unbranded Colombian coffee beans to a non-AE out here, which is, say, for example, I company 2. Now, we also see that this particular I company is selling the same unbranded Colombian coffee beans to F company, and F company is related. So I company is actually related to F company. They are related by virtue of 28% equity share capital, which is obviously greater than 26% share capital. So I company and F company are related to each other. Now I company is selling unbranded Colombian coffee beans to F company. And this is our related party transaction. Now, when this sale transaction takes place, we want to make sure that this is at ALP. So this ALP transaction is to be, this related party transaction is to be substantiated by means of ALP. We find out while, trying to see which method will be useful, we find out that, listen, I company is also selling the same unbranded Colombian coffee beans to a non-AE. So can we actually use this particular transaction to substantiate this particular transaction? Because this is a CUP method. In CUP method, we try to find out an independent entity who's also dealing in the same product, etc. And we use that price to substantiate this particular price. So we can say that to substantiate this transaction at ALP, we can say that we're using CUP. What price are you using? Well, this company is also selling to another related party, and we can use this particular price as the CUP. So this is called internal CUP. Why is it called internal? Because this company is supplying to a related party and this company is also supplying to a non-related party. So this particular company is internal to us, and hence what we do is use this particular price as a means to substantiate this particular price. So this is called internal CUP because we got a company which is comparable to us. We got it internally in our organization. Now, the point is, what exactly is an external CUP? This is external CUP. Let's see that we have a client which is AE1 and this is related to AE2. These are both related parties, and this is a controlled transaction because this is a related party transaction. Now, AE1 is selling unbranded Colombian coffee beans to AE2. Now, we need to substantiate that the price at which they are transacting, this is at ALP. How do we do it? Well, we use CUP. Now, to use CUP, we have to find comparable companies, in the market. When we see that there is a random party, non-AE, and it is not related to another party. These are two random parties in the same country, not related to each other and not related to us also. They are also selling the same unbranded Colombian coffee beans. So what we do is we look at the price at which they are selling unbranded Colombian coffee beans. And because the product is the same to us, we adopt this price as the price for our controlled transaction. And for this purpose, we use comparable uncontrolled price method. We use the CUP method to substantiate this particular price. This is called an external CUP because these two parties are very, very external to us. We're not related to them. We don't know these parties. They're just any two random parties in the industry. So this price can be adopted for our control transaction. And this situation is called external CUP. So if you look at, internal COP, this is internal to us. We are selling to related party and we are selling to non-related party. So we can use this method, this price to substantiate this price. But in this situation, we are not related to these. These are to any random parties. And hence we are using these price to substantiate our price. So they say that if you look at, the international guidelines, if you look at, UN transfer pricing guidelines or OECD transfer pricing guidelines, they always say that internal CUP is the best and not external CUP. So they say that internal CUP is preferred over external CUP. And they say that because in this particular situation, you might have to make some adjustments. But in this particular situation, everything is readily available. All the information is also readily available. So, you can actually go ahead and prefer this over external CUP. Another problem that, can be there in external CUP is that, you might have to make a lot of adjustments, maybe because these are two random parties, maybe the agreement is not available, maybe you're not able to, find out exact information between how dealings are done between these two parties. So they say that internal CUP is the best because you have all information available in this situation. But in this situation, because these are two random parties, all information is not available. So internal CUP is preferred over external CUP. Any questions till now? Okay. Any questions? Any feedback? Is it too quick or, is it too fast? Are you able to absorb? Then we'll go to the second method, which is the resale price method. But any questions before that? Yes, the question is, how do you find out two random parties? I just mentioned that in this, you have to find out two random parties and look at the price, what they are charging. Well, how do you find that? Well, you find it using the transfer pricing database. As I mentioned, we'll go to the database right here. These are databases that you have to purchase, as a company. I'm going to talk about that. There is a method on how do you find out comparable companies. We'll do that towards the end because in all the methods, you have to find out comparable companies. So how do you find that? We'll do that using the transfer pricing database, and I'll explain that to you also. Okay, so there are two types of CUP, just as a recapitulate, there are two types of CUP. One is internal CUP, the other is external CUP. What is internal CUP? Internal CUP means that, this is your transaction and your internal party is also transacting with another party. So this is internal transaction. This is internal transaction in the sense that, your entity is transacting with your related party, and it is also transacting with a non-related party. Meaning to say that this kind of situation, this is internal CUP because your party is transacting with a related party and your party is transacting with another non-related party. So this is a related party, situation, and this is called internal CUP. But external CUP is something which is very, very random. If you want to substantiate, your transaction, it can be done only through external party transaction. So you pick up two random parties. So the difference between internal and external CUP is that in internal CUP, this is the common party. This is your internal party. This is selling to related party and this is selling to non-related party. So this is internal situation and this is called internal comparable. But in external comparable, you have two external parties involved and hence this is called external comparable because in this particular situation, no internal party is involved. And hence this is called external comparable. Okay. Now let's go to the next method, which is basically the resale price method. Now the resale price method is a method, as the name suggests, is used in cases in which resale is actually involved. Now, what is the situation in which resale is involved? Well, do you see resale happening in case of traders and distributors? So what is the role of a trader and distributor? All these people who distribute, commodities, etc. Let's take this example of L'Oreal. Now, L'Oreal is a company, and this is also a case law that happened on L'Oreal. Now, L'Oreal is a company which basically, let's say, manufactures in the USA. Now, to get their products in India, they have a distributor or a trader in India. What does this distributor or trader do? Well, what it does, it procures the commodities, it procures the articles from USA manufacturers. This trader in India, it procures all these commodities in India, and then it sells to end customers in India. So that basically means that there is a parent company, which is L'Oreal USA, as an example. L'Oreal USA sells to a subsidiary company in India, let's say L'Oreal India. And L'Oreal India, it does not do anything on the product. It does not value add, or, there is no value addition that it basically does on this particular product. And just like that, just how it received the product from its parent company, it sells these particular products to the end consumer. But this subsidiary company has a profit margin in between. So let's say that this L'Oreal USA sold their commodities to L'Oreal India at 75 rupees. Now, L'Oreal India sells it to the end customers, to us in India, at 100 rupees. That basically means that this subsidiary company has made a profit of 25 rupees. Why has it made a profit of 25 rupees? Well, that is because it is conducting a commercial activity of, distribution and trading of commodities. So for that function, it has taken 25 rupees, and 25 is the margin that they have earned in this particular transaction. So now, if this is your client situation, if this is your case study situation, that there is a company, and this particular company is actually purchasing from its associated enterprise and reselling it to some end customers in India, well, then you have to use something called a resale price method. So the moment you say that the question is talking about, traders and distributors, you know that the method that you have to use is called the resale price method. But this method is applicable only when this is a related party situation. Now, this is a parent company which is selling to a subsidiary, and the subsidiary is selling to end customers. So now when you see that this is a related party situation out here, then you have to use a resale price method. Now, what do you do in a resale price method? Well, because this is a related party situation, you have to substantiate that the price that the subsidiary company has charged, or the price that the parent company has sold to the subsidiary company, this price of 75 rupees, this is at ALP. Why are we substantiating it? Well, that is because this is a related party situation. So you have to substantiate that this 75 rupees is at ALP. In other words, you can also substantiate that the profit that this subsidiary company has made, which is 25 rupees, this profit is at ALP. Now, this is what you need to substantiate, that the profit that the subsidiary company has earned, which is 25 in our example. Now, you have to substantiate that this 25 profit is at ALP. How do you substantiate that? Well, what you can do is look at related parties in the in the industry who are also doing the same thing. So you can look at any random independent enterprise in the industry who is also getting the products delivered from USA and then distributing it to India. If you feel that they are also earning 25 rupees, then your party is at arm's length price. So if I am able to substantiate that there's another subsidiary company and they are also making a margin of 25 rupees, well, then I can say that I am at ALP. Or in other words, if you find out another company and they are making a margin of less than me. So if I have another company in the industry and they are making a margin of say 20 rupees and I am at 25, then also I am at ALP. Well, that is because on my profit, I'm giving a higher amount of tax and these people are giving lower amount of tax. So as long as I'm giving a higher amount of tax or I am earning a higher profit in India, I am at ALP. So what you have to do is find out different subsidiary company in the industry who are also earning a margin of same as me, which is 25%, or they are earning a margin of lesser than me. So I am earning, as long as you're able to substantiate that I am earning a good amount of margin or I'm earning a higher amount of margin than these comparable companies in the industry, then I am at ALP. So what you have to do is basically, how do you find out these comparable companies? Again, you go to the database, the transfer pricing database, and then substantiate that the margin that other people are earning are also the same. But the point is, how do you calculate this margin? That is the whole thing. So you have to calculate something called a gross profit margin out here. How do we calculate that gross profit margin? Obviously, I did my calculation here. 25 rupees or 25% is the profit this subsidiary company is earning. So that is how you apply something called a resale price method. So one thing, just as a recap, just to go through it again. One, you have to substantiate that there is trading or distribution happening. Then you have to see that this is a related party situation. Then you also have to see that there was no value addition, because this method is applicable only if there is a resale. Resale happens only when there is direct selling. There is no value addition involved in this particular situation. Then what you have to do is calculate the margin, and that particular margin should have been used in not, as an ALP situation. So that is the resale price method. We'll discuss an example now. It will get more clear. But before that, do you have any questions on resale price method? Any questions on resale price method? Or we'll go to the example on how do you apply a resale price method. So what you have to do in a resale price method, I've provided it in, out here also, that, if your margin is 25%, you'll have to make sure that related party margins are also 25% or they are lower than you. If they are lower than you, it's well and good, but it shouldn't be higher than what your margin is. Okay, great. Let's take this example here. This example talks about Earth Private Limited, Calcutta. So that basically means that we're talking about an Indian company here, and this Indian company is engaged in trading of electronic goods. Now the word out here is trading of electronic goods. Trading, that means RPM, it can be used, but it's too early to comment right now. We can have it in our mind that yes, RPM can be used because they're talking about trading, but still let's look at the entire question first. So Earth Private Limited, Calcutta, is engaged in trading of electronic goods. It purchased goods from its AE, Sun Pte Singapore, and also from an unrelated party, Oceana Limited, UK. So that basically means that Earth is basically, the subsidiary company, and Earth is in trading. Now it is purchasing goods from Sun Pte Limited, which is the related party, and also non-AE company, which is Oceana. So Earth and Sun Pte are related to each other, meaning to say that this subsidiary company is Earth, and they are procuring their goods from Sun company, which is their related party. But this Earth company is also getting some goods from another non-related party. So this is Earth company. For the financial year 2023-24, the gross profit margin was 15% on sale of goods of Sun Pte, whereas it was 20% in case of Oceana Limited. Oh no, that basically means that AE situation profit was 15% and unrelated situation margin was 20%. That basically means that when Earth Company was actually purchasing goods, from Sun Pte Limited, the margin here was 15%. And when they did the same thing from another company, which is, non-related companies were earning a profit margin of 20%. So that basically means that we are not at ALP because we are earning a lesser profit margin than, the related party situation. We should always earn more than what related parties are earning, or, similar, but not lesser. But in this situation, our related party is earning a margin of 15%, and the comparable margin or margin in unrelated situation is 20%. Let's see what we can do about it. After sales warranty of 6 months was provided by Sun, whereas Oceania, which is non-related, gave after sales warranty of 1 year. The cost of warranty is 2% of sale price. That basically means that this is an adjustment. We can see if adjustments can be done. The Sun PTE's brand value is internationally known, and the benefit of the brand value can be taken as 1% of the sale price. During the financial year 23-24, it sold goods of Sun Pte Limited of 20 crores and Oceania 15 crore. So this particular Earth Company, it sold some commodities. This commodity from Sun was 20 crores, and the commodities that it sold from Oceania was 15 crores. As regard transport cost of goods purchased, there was no difference between related and unrelated party. Compute the ALP of the transaction between Earth and Sun by applying resale price method, considering the facts of this particular case. Now we have to apply the resale price method, obviously, because this is a situation of trading companies, and we'll have to make some adjustments also. But first thing that we know is that our margin is 15%. And the comparable margin is 20%. That basically means that our margin should also have been 20% because there are comparable companies in the industry that are also earning 20%. So the ALP should have been 20%. But we need to make some adjustments because the question asks for adjustments also. So let's see how we're going to solve it. So what we do is, what is the resale price of goods for Sun Pte Limited? Well, it is 20 crore rupees. It is mentioned in the question that the resale price with related party situation is 20 crore rupees. Now it says that profit margin that you need to deduct to see what was exactly the cost, that profit margin should not have been 15%. It should have been 20% because that is the correct margin. So what we'll do is from 20 crores, we will subtract the ALP profit margin, which is 20% on sale. 20% was with, if you guys remember, 20% was the ALP, which was non-related situation. And this should be deducted, not 15%. So what we'll do is, this was the resale price. We'll deduct the profit margin, which is 20%, which comes to, 4 crores. So our price, the cost was 16 crore rupees. Now in the 16 crores, we will make some, adjustments so as to see that what exactly was the ALP in this particular situation. So what we're really trying to do is, we have the, resale price, which was 20 crore. From this resale price, if we deduct the profit margin, we will come to what was the transfer price. And then we'll have to substantiate whether this transfer price was at ALP or not. So we have the resale price, which is 20 crore, minus the profit margin, the correct one, which is 20%. So this is 16 crore. Now we'll make some adjustments. The first adjustment that we need to make is of the brand value. So it says that, the brand value is, known for this particular brand, and the brand value is 1% of the sale price. So what we'll do is, because this brand value was there for Sun and it was not for the related party, unrelated party, we will add back this brand value, which is 1% of the sale price. That means 1% of 20 crores, and this is going to be 20 lakh rupees. Now we'll also have to make an adjustment for this warranty. The warranty which was, provided to Sun, but it was not provided, otherwise. So less the adjustment for warranty. How much is the warranty adjustment? Well, it says 2% of sale price, which is 2% of, the sale price, which is 20 crores. But the warranty is, if you see, 6 months that was provided. So then into 6 by 12. So the warranty comes to 20 lakh. This will be lessened. And the arm's length price actually comes to something called 16 crore rupees. So meaning to say that the arm's length price should have been 16 lakh rupees for this related party transaction. So, and this is what the question also asked, the ALP of the transaction. This is what you need to find out between Earth and Sun, meaning to say that you were supposed to find out the ALP of the transaction between Earth and Sun. Sorry, Earth and Sun here. So this is what you had to find out. And what we were actually given was the resale price. So if you deduct resale price minus, the profit margin, the ALP profit margin, this is what you actually get. And this is what we're trying to do. The resale price minus the profit margin, the resale price minus the correct ALP profit margin will give you this, and make all the adjustments that are provided in the question. You will get the answer, which is what is the arm's length price. But the point is that in this particular question, this 20% on sale was given, that, other people in the industry are actually earning 20%. But generally, this is a practical scenario wherein we do not know what other people in the industry are earning. So this amount is to be established using transfer pricing databases, that, these particular companies were earning 20% and you are earning a profit margin of 15%. This is what we need to establish, what are other people in the industry earning. And that's how we use something called transfer pricing databases to see what exactly is the profit margin that other people in the industry are actually earning. Okay. Any questions here? This is a question from the study manual. You can also go through this particular question again. If you have any questions, further when you revise on your own, please feel free to get in touch with me. Okay, any questions here on resale price method? Otherwise, we'll move to the third method, which is the cost plus method. Before we move to the cost plus method, I'd like to know if there are any questions. Okay, let's do cost plus method. If there are no questions, let's do cost plus method, and then we can take a break. But any questions before that? Okay. This might sound very overwhelming right now if you look at, the methods, but we're taking the methods one by one. You'll have to go back and, do some more questions and, revise through these particular methods and see, what the law says, what is provided here, how do you start with a particular method, and then it'll come easy. But it's all logic. If you understand the concept on, what exactly is the arm's length price, if you understand that particular concept, then it's going to come very, very easy. Any questions? Okay, great. The next one is the cost plus method. Now, the cost plus method is also very, very similar to the resale price method. But in this particular situation, this is available for manufacturers and, contract manufacturers, etc. So, in producers, etc. So, the cost plus method is for manufacturers, and the resale price method is, there for distributors. Now, what happens in the cost plus method is that we're talking about a manufacturer. What does a manufacturer do? Well, they manufacture, as simple as that. Well, they manufacture in the sense that they have all the costs to a product. So, if I decide to manufacture, say, for example, a pen, I know that the cost of, manufacturing, the direct cost and the indirect cost of production, or the direct and the indirect cost of manufacturing in this particular case is, say, for example, 100 rupees of manufacturing this pen. I decide to sell off this pen in the market at 125 rupees. Well, that basically means that I have retained a profit of 25%. And that exactly what happens in a cost plus situation. In cost plus situation, in a cost plus method, all that we are concerned with is a subsidiary company, which is basically manufacturing. Let's say that this is a subsidiary company which is manufacturing a pen. The direct and indirect cost of production is 100 rupees. Now, this subsidiary company decides to sell this particular pen to the parent company. When it sells it to the parent company, it sells it at 125 rupees. That basically means that this subsidiary company has made a profit of 25 rupees on this particular transaction, or a margin of 25% on this particular transaction. Now, what we have to do is substantiate that this 25% of margin, which has been earned by the subsidiary company, is at arm's length price. How do we substantiate that? Well, what we'll do is we'll look at other comparable companies in the industry who are also manufacturing that particular pen. And if they are also earning a margin of 25%, then we are at arm's length price. Or maybe they are earning a margin which is lesser than us and we are earning a greater margin. Well, if that is the situation, then also we are at arm's length price. So what we need to do is find out the direct and indirect cost of production, find out the transfer price, which is the sale price, look at the profit margin, calculate the profit margin of our company, and then calculate the profit margin of comparable company. If these profit margins on the cost price, if they match, then we are at ALP. So this is what we need to do in a cost plus method. And this is the reason that the slide says that it compares and identifies the markup. Markup basically means that this profit markup, this markup in the sense that 125 minus 100, which is 25%. This markup, which is earned on indirect and direct cost of production, that you need to compare this with independent comparable companies. And the only difference between resale price method and cost plus method is that in this, we are talking about manufacturers. And if it is manufacturer, then it is going to be, the markup. And in resale price method, we were talking about, traders and distributors. So it was, a percentage, a margin that was retained by traders and distributors. But in this particular situation, we're talking about manufacturers. So we need to see what is the markup that is earned by these particular manufacturers. And this particular cases involved manufacturing activities, etc. So just to recapitulate, in cost plus method, let's say that there is a associated distributor and an associate manufacturer. The manufacturer is manufacturing a particular commodity, and it is, say, for example, manufacturing 1 lakh iPhone cases, and it is selling it to the distributor. Now, the cost is 1, but then what should be the profit margin that should be retained by this particular manufacturer? Well, how do we find out that profit margin, or what is the cost plus or the markup in this particular situation? Well, what we'll do is we'll look at any third party manufacturer who is also manufacturing and selling it to a distributor 1 lakh iPhone cases. We see that they are earning a profit markup of 5%. So what we'll do is we'll adopt this particular markup as the ALP for our situation. So that is what we do. But for this particular situation, it's a two-step process. One, we'll have to look at random companies, or we'll have to look at comparable companies in the industry. We call them comparables. We look at comparable companies in the industry. The comparable companies, are earning a margin of 5%. So we'll use that 5% as, the ALP. But for this particular situation, we'll have to make sure that if adjustments are required, then we'll have to make those adjustments as well. So step 1, we'll have to find out comparable companies in the industry, look at what is the profit margin that they're earning. And second step, if any adjustment are to be made, these brand value adjustments or credit period adjustments, or any other adjustment for that matter, if those adjustments are to be made, we'll have to make use of those particular adjustments, and then we will be arriving at the arm's length price. So it's a two-step process. We'll discuss a question here and then let's take a break. This is, the cost plus method and a question on cost plus method. But any questions here before that? Okay. If there are no questions, let's take, a minute and read through this particular question. It's a long question. Let's take 1 minute to read through this particular question right here. Please, can you drop a message if this is clear? Okay, let's take you through this particular question here on how to apply the cost plus method. Let's say there is an ABC Limited which is in Canada. So this is a Canadian enterprise, ABC Limited. It holds 35% shares in LMN Limited, which is in India. Um, you know that when ABC Limited holds, Canadian company holds shares of LMN Limited in India, you know that these two are entities related to each other. Well, that is because they are holding 26% more share capital in the other enterprise. If they're more holding 35%, obviously they are related to each other. So related party is established. The second leg is LMN Limited develops software and does both on-site and off-site consultancy services, for customers. So basically, the Indian entity provides consultancy services to ABC Limited. Because providing consultancy services, this is provision of service. This is covered as an international transaction as per Section 92B of the Income Tax Act. That means that this is an international transaction. So related party, international transaction, hence transfer pricing provisions will be applicable. LMN Limited during the year billed ABC Limited Canada for 120 man hours at the rate of 1800 per man hour. That basically means that, because LMN Limited was providing services to ABC Limited, they were charging them for 120 man hours at the rate of 1800 per man hour. The cost of production, the cost of providing these particular services, the total cost, direct and indirect cost for executing this work was 2,25,000 rupees. That means the LMN Limited, had a cost of 2,25,000 rupees and they were billing them for 120 into 1800 per man hour. However, LMN Limited billed XYZ Limited India at the rate of 2,800 per man hour for similar level of manpower and earned a gross profit of 50% on its cost. That basically means that this particular LMN Limited, they are providing services to AE, which is ABC Limited Canada, and they were charging them 1,800 rupees per man hour. But they were also providing services to a unrelated party. And when they were providing services to this unrelated party, they were charging them 2,800 rupees per hour. That basically means, and they were earning a gross profit of 50% on cost. That means if they're actually selling in India, they are, with a related party, they are selling at less price. But when they're actually selling to an unrelated party, they are selling at a higher price. That means that this is not at ALP. And we'll have to calculate the arm's length price. Now, the transactions between LMN Limited and ABC Limited and XYZ Limited, they are comparable subject to the following differences. That means that the question is asking for adjustments. These are all the adjustments. While LMN Limited derives technological support from ABC Limited, there is no support from XYZ Limited. That means that we'll have to adjust it to the technology support. The technology support is 18% of normal gross profits. Then there is a quantity discount, which is 10% of normal gross profits. And there is no risk or no marketing cost. In case of services to XYZ Limited, they are assuming all risks associated to marketing. And this is estimated at 12% of normal gross profits. Then there is 1 month credit period also, which is 2% of gross profits. So there are 4 adjustments that we need to make in this particular question. It says compute the arm's length price along with the income to be increased under the cost plus method. So you have to do 2 things. First, you have to compute the ALP. And then the second thing that you need to do is calculate the income to be increased, as in the adjustment, that will be initiated, if at all, by the tax authorities. So how do we start a question which is asking us for a cost plus method? So what we do is we take the gross profit of 50%, which is through an unrelated party. We take this particular gross profit and we make all the adjustments possible. And then we see what was the gross profit in our situation. And then we compare the 2 gross profits. So what we'll do is let's take the gross profit of unrelated party, which is, 50%. We'll have to adjust it to functional differences. The first adjustment is the technological support adjustment. ABC Limited provides technological support, but XYZ does not provide technological support. And this is XYZ's, profit margin. So we'll have to delete this profit margin because it is not provided here. The profit margin is going to be 18% of gross profit. That means 18% of 50%, and that comes to 9%. Similarly, there was quantity discount. We'll have to adjust quantity discount also. Quantity discount was 10% of gross profit, which becomes 5% now. Risk and other associated costs relating to marketing, because they were not there for ABC Limited and they are there for, the unrelated party. So we'll have to delete this also. So that will be 12% of gross profits, which becomes 6%. So that basically means that we'll have to delete 20%, and now our profit is 30%. But there was a credit adjustment because there were 4 adjustments. So we'll have to add the credit adjustment, which is 2% of 50%, which is 1%. So that basically means that arm's length gross profit margin was 31%. That basically means that, if unrelated parties are charging 50%, if we adjust it to our situation, ALP, as in, parties should have charged something called 31%. That should have been charged by everyone in the industry. Now let's see how much we charged. So it says that, for this particular work, they have charged 2,25,000 rupees. This is our situation, the cost which is incurred by LMN for executing ABC's work. So this is provided in the question that they have executed this work for 2,25,000 rupees. This is the cost. Now we're talking about cost plus method. That means we take the cost and now we'll add the profit margin, but we'll add the ALP profit margin. Let's see what is the profit margin. Well, the profit margin is 31%. We just calculated it here that ALP profit margin is 31%. So cross 31% will be added to this particular cost, which is this is the profit margin, and hence you should bill them 2,94,750 rupees. But let's see how much we have billed them. We have billed them 120 man hours at the rate of 1,800 plus man hours. So that basically means that we have billed them 120 into 1,800. We have billed them 2,16,000 rupees. But what is the ALP that we should have billed them? Well, we should have billed them 2,94,750 rupees. So that basically means that adjustment will be required for 78,750 rupees out here. So this is how you tackle a situation relating to CUP. What you do is in CUP situation, you see, what is the margin that should have been retained? What is the arm's length margin? How will you find out the arm's length margin? Well, you see what are comparable companies in the industry doing. We find out that the comparable companies were doing a 50% margin. So we said that, because there are so many adjustments given in the question, we'll make all these adjustments. When we made all these adjustments, we got the profit of arm's length profit of 31%. That basically means that if you want to deal at arm's length, you should also charge a margin of 31% onto the cost. What is the cost? Well, the cost was given in the question, which is 2,25,000. Now, that basically means the cost of providing services to ABC Limited was 2,25,000 rupees. Plus, you will retain a profit margin. How much profit margin? Arm's length profit margin. How much is the arm's length profit margin? It is 31%. So that basically means that you should bill them for 2,94,750 rupees. But you know what? What you did as an Indian enterprise, you billed them less. Why did you bill them less? Because we will pay less tax in India then. So that is not allowed. So what the tax authorities will do, they will add 78,750 rupees and now it will become 2,94,000. This is what you should have billed them and this is what LMN Limited should have earned in India. And this is the amount on which they should be paying taxes, not 2,16,000 rupees. And this is what is the crux of this particular question. Any questions here? Okay, let's take a break here for, till 7:45. Let's take a 10-minute break and then come back and discuss the next method, which is called the transactional net margin method, which is TNMM. Let's take a break here for 10 minutes. Move to the next method now, which is called the transactional net margin method. We generally call it as an abbreviation. We call it TNMM. But before that, anyone who has a question on any of the above methods? Anyone who has a question till now? Anything? I know this is a little technical. All the methods, if you see, if you look at the questions, I know that this is a little technical. And I can assure you that this is the most technical part in transfer pricing. There's nothing else, which is more technical. Only a few calculations relating to these particular methods. But, if you're able to use logic, you'll be able to find out, what the question really asks for. Okay, great. So let's move to the next, method, which is TNMM. Now, what we do in TNMM is to actually find out the net profit from a transaction. When I say net profit from a transaction, I basically mean that, if my related party is actually, transacting, or my two related parties or two AEs are also transacting with each other, I try to find out the margin that they are earning from that particular transaction. And then what I do is I find out comparable companies in the industry, or I find out independent parties in the same comparable situation, and I try to find out what is the margin that they are earning. I compare the two margins, and then I'm able to find out whether my party is at ALP or not. Meaning to say that what I'll do is I'll go back to my case study, and what I'll do is I'll try to see what is the margin that my party is earning. So I'll look at this particular situation, and I'll try to find out that what is the margin in percentage terms, what is the margin that my related party is earning. Then what I'll do is I'll try to find out similar companies in the industry. When I say similar companies, I basically mean that all those comparability factors that we discussed, and I'm going to, talk about them in detail going forward also. I will have to make sure that what are independent parties in comparable situations, what is the margin that they are earning when they undertake similar transaction. So if my related party is, say, for example, an Indian entity is providing support services to the USA entity. And then in terms of providing these support services, my Indian entity is making a profit margin or a net profit margin of, say, 15%. Then what I'll do is I'll look at other people in the industry. Maybe I'll look at some other Indian entity which is also providing, support services of the same kind to its USA entity. And I find out that, listen, they are earning a profit margin of 20%. That means the 15% margin that I am earning, that is not at ALP, because other people in the industry are earning more than me, which is 20%. So I am, somehow trying to hide my profit, and that 5% will be added back. So in TNMM, what we do is we try to calculate the net profit margin, one, in my related party situation, and then second, in my third party situation. And then I try to compare these two. Whatever is the difference will be added back. So that basically is something called the transactional net margin method. There are two methods that are practically very, very, commonly used. The first one is the CUP method, and the second one is TNMM method. And if you see the litigation in India, about 60% of the litigation in India is on the use of methods, and within that also the litigation which is quite prevalent is basically on the concept of CUP versus TNMM. So they try to find out which method is more suitable. Is it going to be a CUP or is it going to be a TNMM? That these two methods are always in a tiff that ways. So TNMM is very, very easy. They just say that, listen, calculate the net profit margin from your transaction and then compare it with the net profit margin that independent enterprises in comparable situations are also earning. And then if you feel that, on that comparison, your related party is doing, more margin, then it is at arm's length price. So now there are two things. There are a few things actually in TNMM. The first thing is that you have to calculate a net profit margin. The net profit margin that you calculate is basically net profit or operating profit, and then divided by a denominator which is an appropriate base, which is can be cost or sales, etc. So let's say the profit margin. How do you calculate it? Well, operating profit divided by cost and into 100. That particular thing is called profit level indicator. It's just a fancy word that we use to net profit margin. Profit level indicator is basically the ratio of net margin or operating profit divided by sales or divided by cost into 100. That is called PLI, or profit level indicator, in a transaction net margin method. And you have to calculate the profit level indicator of your transaction, compare it with the profit level indicator of independent parties, and then make a comparison. If it is fine, it is going to be at arm's length price. Now the question is, and this is what you're going to be telling me, and you will very quickly write it on the chat box. Now, when I say that, there was an Indian enterprise in our example, I said that, I have an Indian entity and it is related to a USA entity, and the Indian entity is providing back office support services to the USA entity. And I said that you have to calculate the margin of this particular transaction. And I said that the margin is 15%. Now, the point is, do I calculate the profit margin of the Indian entity, or should I calculate the profit margin of the USA entity? What should I do? So this is what you have to tell me. What should I do in this situation to calculate the profit margin of this transaction? Should I calculate the profit margin of the Indian entity and compare it with the profit margin of other Indian entities? Or should I calculate the profit margin of the related entity in USA and compare it with profit margin of other USA entities out there? So what should I do? Which profit margin should I calculate? This is what you need to tell me. I'll wait for your answer. Please tell me. You can put it in the chat box. So should I calculate profit margin of Indian entity, or should I calculate profit margin of USA entity? Yes, exactly. So I calculate the profit margin of the Indian entity. Well, if you say that, well, there are a lot of reasons why we would say that. Well, the profit margin of whichever entity that you calculate is one going to be called as the tested party. So the tested party means that, the party for which you are calculating the profit margin. In transfer pricing terminology, it basically means something called the tested party. Now, the tested party basically, which entity is going to be the tested party? There are no definitions which are provided in the transfer pricing regulations on which is going to be a tested party. They say that, the law says that the least complex entity is going to be the tested party. But the point is, isn't it very subjective to say what is the least complex entity? So they basically say that least complex entity is going to be the one which, for which all the information is readily available. Then they also say that which does not own significant intangibles and which does not even require adjustment. So if I feel that, I am able to have information readily available for the Indian entity, then I should make Indian entity as the tested party. So if you said Indian entity as the tested party, well, that is because we generally feel that the information on the Indian entity is readily available and hence it's going to be the tested party. So what we'll do is we'll calculate the profit margin of the Indian entity and then compare it with the profit margins of, other Indian entities. And then that will be basically the tested party. And then we'll be able to see whether this is at ALP or not. So there are a lot of factors that are available to determine what exactly are the tested parties. First is, yes, the reliability of the information. Then they say that the least complex entity should be the one. So, if you're holding intangibles, obviously you become a very complex entity. So the entity which is not owning significant intangibles, that is going to become the, tested party. So you have to say which entity is going to be the tested party. There is a lot of litigation in the country on which will become the tested party. Sometimes they say that the Indian entity is the least complex because it's a very subjective thing. Sometimes they say that the foreign entity is the tested party. Then there was a lot of litigation in the country wherein they said that the foreign entity, which is the US entity in our situation, they said that the foreign entity cannot become the tested party, all that, but everything is resolved. They basically now say that the least complex entity is going to be the tested party, and it's absolutely fine. You can make the USA entity also the tested party, but then you will have to make sure that the financials of the USA entity are readily available. You'll have to ask the client for financials. Then you'll also have to make sure that the calculations are fine. Then you will have to also make sure that you compare the margin of the USA entity with the margin of other USA entities. So you'll have to get a transfer pricing software which is giving you information of USA entities. It becomes a little complex, but generally the least complex entity is going to be the tested party. So I have two examples here. Let's see this particular example and then let's see what is going to be the tested party. So in this particular situation, there's company A. It just does a very simple function of manufacturing. Then it manufactures product 1 and it sells it to company B. Now, company B is very, very complex. It is, giving all the technical specifications. It is holding a lot of intangibles, etc. So in this situation, if you need to calculate the profit margin when company A is manufacturing and selling the product to company B, you have to calculate the profit margin. What profit, which company do you take as the tested party? Well, you take company A as the tested party because it is doing all the simple functions, and company B on the other hand is actually holding all the intangibles. It has all the technical specifications, etc. So you do not take that as a tested party because in terms of calculations, in terms of calculating the net profit, all the intangible calculations, etc., it's going to become very, very complex. So you take the simple entity as the tested party and you calculate the net profit margin of the simple entity. So in this situation, company A is going to be the tested party. In a similar situation, in another example, there is company A, and this is again manufacturing, and it has all the intangibles using which it is manufacturing product 2. And then it is selling it to company B, which is a distributor, and they just perform the simple function of, distributing whatever they've received from company A, that is distributing in their own jurisdiction. So in this particular situation, if you see, intangibles are held by company A. This is a very, very complex entity, and company B is a very, very simple entity. It's just providing some distribution functions, etc. So company B is going to be the tested party in this particular situation. So that basically means that if you're adopting Tnmm for this particular transaction, then is it going to be company A or is it going to be company B? The tested party will be company B. You will calculate the profit margin using financial statements of company B. And then after you've calculated, the profit margin, you will test it with other tested parties, with other comparable companies in the industry and see if it is it is at ALP or not. Meaning to say that you will calculate the profit margin, the net profit margin of company B, and then compare it accordingly. So it is important under Tnmm first to calculate the net profit margin, and then second to see which net profit margin do you need to calculate. Should it be of the Indian entity or the USA entity? Just as an example, it could be any transaction. So that is called the tested party. So I have a question on the chat box that in case of manufacturing companies, we use cost plus method, then why not, then why TNMM method? What happens is, as they say, that methods are very specific. They say to the facts and circumstances. When I say facts and circumstances, what happens in a lot of situations that, the direct and the indirect cost of production are not available. So if that is the situation, if direct and indirect cost of production are not available, then you do not have to, you can't use a CPM because CPM says cost plus method. So if you're not able to establish, what is the cost of production, you cannot use that particular method. Then what you do is use the TNMM method. Or in other situations, what happens is you'll have to make sure that, the um, a lot of times, there are accounting inconsistencies. Maybe in India, we take, say, for example, the cost of stationery. So we take the cost of stationery as, indirect expenses. Just as an example, we take stationery cost as indirect expenses. Now, we are trying to compare it with another entity, and maybe that particular entity is in a jurisdiction where they're not using indirect cost. They do not consider stationary cost neither as direct nor as indirect, so then that comparison will become flawed. So what you basically do, you cannot use cost plus method in that particular situation. Then what you do is you use the TNMM. Then a lot of times, what happens is there is not a differentiation. Maybe, you have the financials, but the differentiation between direct and indirect cost of production is not available, or, the costs are not available. Then also what you do is you use the TNMM method. Or sometimes, what happens is if you looked at this particular question, this question on CPM method very clearly says that these are the adjustments, but a lot of times these adjustments are, not available. So then what you do is you just take out the, net profit from the entire transaction. You don't even consider, the costs and, what is the markup, etc. You don't even consider the adjustment. You just want to take out the, the profit from the entire transaction as a whole, the net profit, and then see how you can compare it. So it just depends on what is the information that is available to you, sorry, in that particular instance, and then you actually make a decision. So when I said that it's going to be the most appropriate method, it's just and I'm going to talk about what method will be used when, but it just depends on what is the kind of information that is available to you. A lot of times, people prefer TNMM because for TNMM, you just need one financial. You don't need the segregation. All the segregation in Indian accounts is available, the direct and the indirect cost of production, etc. But a lot of times, if you do not have it available for comparable companies, then it becomes a problem, because for comparable companies also you need that differentiation between direct and indirect cost of production, and sometimes it's not available in the databases, etc. So what you do is you just use the TNMM method that way. So it just depends on information availability. So coming back, this is the question. Please take a minute to go through the question on TNMM and then we'll discuss it further. This is the question that we have for TNMM. So, meaning to say, what you do under TNMM is to compare profit margin with the unrelated parties' profit margin and then see if there is a difference. Okay, let's go through this particular question on TNMM. It talks about some Andes Incorporation, which is having its business in Malaysia. and it has advanced a loan of Malaysian dollars MD 1,60,000 to Andes India, Andes Limited India. So that basically means that there is some Andes Incorporation, and this is a Malaysian company. This has given a loan to the Indian company of 1,60,000. Now, the book value of total assets of Andes Limited was 1,25,000. So, book value of the Indian company is of the assets is 1,25,000 lakhs. 125 lakhs, sorry. Now they say that Andes Limited provides software backup support to Andes Inc. Now, the first point that we need to see, I will go to the question, in a bit, but first thing that we need to see is, are these even related entities? Well, the transaction that they're providing, the Indian entity is providing backup support services to USA entity, that is an international transaction as per 92B. The first part of the question is, and there are marks for these things also. The first part of the question is this even a related entity? Now you have to tell me what is the situation. They say that this particular percentage, if you give a loan of dash percentage of the book value, then you become related parties. What is that percentage? If one entity gives a loan of dash percentage of the book value of the other enterprise, then they become related to each other. So what is this percentage? What percentage are they talking about? If one entity gives a loan of dash percentage of the book value of the other enterprise, book value of assets of the other enterprise, then they become related to each other. What was that percentage? We did this in the last lecture. Exactly. It was 51% or more. So now today also we'll have to see in this particular question that if the loan that was given by Andes Incorporation, it is more than 51%, or even if it is 51%, then they're going to be related to each other. So if you see, the book value is 125 lakh. The loan is 1,60,000 Malaysian dollars. But we need to convert Malaysian dollars to INR. The conversion is given here. 1 Malaysian dollars is 45 INR. So that basically means that the loan amount is 1,60,000 into 45 INR. And the loan, we'll have to calculate the percentage that, the loan is how much of the book value of assets. So how do we calculate that? The loan will be this amount. This is the amount of loan, 1,60,000 Malaysian dollars into 45. And how much is it in terms of, the book value of the asset? The book value of the asset is 125 lakh into 100. So that basically means that this constitutes 57.6% of the book value of the asset. And obviously, this is more than 51%, and hence it's going to be related to each other. This is also, you'll have to do this initial calculation because there are marks that will be allocated to this calculation also. So that basically means that these two companies, Andes Incorporation and Andes Limited of India, they are related to each other because Andes Inc. has given a loan of 51% or more of the book value to Andes Limited, and hence they are related. And transfer pricing provisions will be applicable. Yes, absolutely. Yes, the calculation in the chat box also that you guys have given, that is also correct. So this is going to be 57.6%. Now we have to see that Andes Limited has spent 50,000 man hours during this financial year for the services rendered to Andes Inc. They say that this Indian entity, they are providing services to the USA entity. They have spent 50,000 man hours in providing these services. The cost is MD Malaysian dollars 75 per man hour. So now you have, the cost, and they have billed Andes Inc. at 90.75 man hour. That basically means the Indian entity has, the cost of the Indian entity is 75 and they have billed, as in they have sold it for 90.75. So it's very easy to calculate the profit because the cost is 75, the sale price is 90.75. So we can calculate the margin. We will calculate it in a while. Now they say that Gamma Limited in India, which has similar business model, provides backup support services to Olive Inc. in Malaysia. That means we have a comparable company. So this is our related party transaction. This one. This is our related party transaction. And this is our comparable company transaction. There is another company in the industry, Gamma, which is also an Indian company. And they are also providing backup support services to a USC entity. And they have given us the direct cost of production, indirect cost, and profit margin, operating profits of this particular entity. So now what we need to do, this is calculate the arm's length price for the transaction between Andes Inc. and Andes India based on the above data of Gamma Limited using Tnmm and explain if there is adjustment to be made. So what we need to do in Tnmm, as I mentioned before, is basically to calculate our profit margin, as in a related party profit margin. I think it can be calculated from here. And then we need to calculate the profit margin of the related company, which is Gamma to Olive. And then see, and then compare the two, and then we'll get to know whether this is at ALP or not. So step one, let's see what is the profit margin, what is the operating profit margin of our related party transaction. Well, our our selling price is billing per man hour. Our selling price is 90.75. It was there in the question that we are billing them at 90.75. But remember, don't forget to, make this silly mistake of converting this. Make this, make this conversion. Don't make this silly mistake. So the selling price is 90.75, but because this is Malaysian dollars and we need everything in INR, we multiply it by 45. So our selling price of this particular transaction, of this particular support service, is 4,083.75. What is our cost? Our cost is 75. This was also given in the question. It's given right here that the cost is 75. The cost for Andes Limited is 75. So 75 into 45 converted into INR, that is 3375. That means our selling price is this, our cost price is this, and that basically means that our operating profit is 708.75. What is our margin? Well, the margin, or as I mentioned, the PLI, the profit level indicator, is operating profit divided by cost into 100. So that is operating profit. We just calculated 708 divided by cost 3375 and multiplied by 100. So that gives us that this is the margin that we are operating at. We are operating at a margin of 21%. Now, second leg of the situation is, let's see what other people in the industry are earning, what our comparable companies are earning. For them, the information is given that they have a cost of 600, indirect cost of 800, their total cost is 800, their profit margin is 200. So their PLI is going to be profit divided by cost into 100, just like we did for this, profit divided by cost into 100. So for them, the margin is 25%. That basically means that we are earning a profit margin of 21%, but all the competitors in the industry are earning a profit margin of 25%. That means that this is not at ALP. We should earn either equal or more than our competitors. Otherwise, if we're earning lesser than the competitors, then we're somehow trying to hide profits and we're paying lesser profits. And that is going to cause a transfer pricing adjustment. So we're lagging behind in this particular situation. And we also need to earn at least 25% so as to be at arm's length price. So what we do is we calculate the arm's length price. What is the correct arm's length price? How do we do that? Well, we see what is our cost, which is cost is 75 into 45. This is our cost, which is 3375. We just calculated it. Add the margin. What is the correct margin? Well, the correct margin is 25%. It is not 21%. We are earning 21%, but we need arm's length margin. What is arm's length margin? What other people in the industry are earning. What are they earning? Where they're earning 25%, we should also earn 25%. So that basically means that the margin should be 25% of the cost, which is 25% of 3375, which is 843. So the arm's length price is going to be 4218. That means the cost plus the margin, which is 4218.75. And then 4218.75 multiplied by the total number of man hours. That means the total cost, the total arm's length price that we should bill Andes Inc. is 21 0.09 INR that ways. So this is what we should be actually charging them. But so this is basically, let's see what is the adjustment that will be made. This is going to be the arm's length of man hours. We just calculated it. What are we actually billing them? We are billing them, let's see in the question. The cost is this. We have billed them 90.75. So we are basically billing them 90.75 into obviously 45 to make it INR into 50,000 man hours. We have billed them 20.41. So what we'll do is we'll initiate an arm's length adjustment. We should bill them 67 lakh 50,000 extra. This is what the tax authorities will do because we were not at arm's length. Because we were not at arm's length, it was established here, we were just doing 21%. Other people in the industry were doing 25%. That means this 4% adjustment will be made by the tax authorities. How do we calculate this 4% adjustment? I mean, you cannot calculate 4% of what. So this is the reason we have to go through all this calculation that we should have billed them 21. We were billing them 20. So tax authorities will initiate an adjustment of 67 lakh 50,000 rupees so as to make sure that we are at arm's length price. Any questions here? This is how you calculate a Tnmm situation. So if a question says calculate Tnmm, again, what you'll do is you'll calculate your related party profit margin, then you will calculate your competitor's profit margin and then compare the two and then see what is the adjustment that will be actually taken. Okay. Now, whatever methods that we have, this is, the fifth method that we have. I can tell you whatever methods that we have now will not involve calculation so much. Now, these are just, methods. The calculations are involved in CPM, cost plus method, resale price method, and Tnmm. Those methods involve calculation. These methods are most for understanding purposes. You'll have to understand the concept. The calculations are not so much in profit split method and the final one, which is other method. But before that, if you have any questions, please, put it in the chat box and I'll continue then. Okay, so let's go to the next one, which is the profit split method. Now, in profit split method, because this is again, more requires theoretical things, this is used in situations where transactions are very, very interrelated. Now, if you look at Tnmm, transactions were very separate. One transaction is provision of software services. The other transaction is, probably accounts receivable. The third transaction is, manufacturing, etc. Transactions can be, segregated. The profit that you're making from supplying software services, the profit that you're making from distribution activities, the profit that you're making from manufacturing activities. But, if you look at situation like a balance sheet, sometimes the transactions are very, very interrelated that you cannot evaluate them on individual basis. You cannot evaluate that, this is the cost that you had spent on this transaction. This is the cost that you had spent on this transaction. They're very, very interrelated. So in these particular situations, what you do is you actually calculate the profit from the entire project as a whole, and then you divide it on the basis of some split method. You divide it on a profit split percentage. How you actually come to that profit split percentage, that's another thing that depends on what other people in the industry are doing, or you're gonna see it says thorough functional analysis. That basically means that you're going to see what are the functions, what are the assets, and what are the risks that were involved. So if two entities were involved, you'll see how much was the functions which were done by entity one, and then how much was the function in that particular project that was done by entity two, and then divide it accordingly. So you have to come up with some profit split percentage so as to see how do you split profits from that particular transaction. But the thing is that you cannot segregate that particular transaction. They're very, very interrelated to each other. So that is the profit split method. Let's take an example. It's going to get more clear then. Let's take the black font example. So in this particular example, there were two AEs. These were associated enterprises, and they had a project that they were coming up with. They were coming up with a new medication in the market. So what they did was to involve this, to have a new medication in the market, they spent a total of $500 million. Now, the thing was that in this particular situation, R&D, the research and development was $375 million in the total investment. Now, the thing was that they're not able to establish that who did what and, what was basically done. So what they did was they used the profit split method, and they decided that because research and development was $375, that's basically 75%. The R&D, whatever profit that they make in future, R&D company will get 75%, and the drug manufacturing company will get the 25%. So what they did was they actually segregated on the basis of who did what function. One company did R&D, one company did manufacturing. They said that this company did R&D, that's going to be 75%, and that's going to be 25%. So what they did was whatever was the profit, they had split it in between them. Profit split method is, I can tell you practically, people say, and everyone in the industry say, that it is the most complex method, and that is because profit split method comes into play when there are intangibles involved. When, if you see in this one also, there was intangible that was involved by the R&D company, etc. So whenever you see that there are intangible assets involved, that the method to be used is a profit split method. And it's very difficult to find out at what percentage will they be split between. But that is how profit split method is the most complex method out of all the methods, and the one which is least used, because practically everyone wants to use CUP or they want to use Tnmm, etc. Let's take another example here, which is a manufacturer owns a brand and sells products to an affiliate in another country. Okay, the affiliate sells to third-party customers in that country. So that basically means that there's a manufacturer. They are selling it to a related party, and the related party then sells that particular product to third-party customers. The affiliate has invested money in building the customer base and developing the market in its country. As a result, not all the profit which is generated in that country can be either attributed to that brand or the local affiliate. Now, what happened was, by the affiliate, they created the customer base, they developed the product, etc., and then they sold it to the subsidiary, and then the subsidiary sold it to third-party customers. Now they're not able to establish that how much profit should be generated by the manufacturer, how much profit is to be given to the distributor. They don't have a profit split. Now what they do is, if they use profit split method in transfer pricing, they can determine how much profit from the total transaction is to be split between the manufacturer and the affiliate. But again, the profit split percentage, on what basis will they split it? It just depends on facts and circumstances of the case. They'll have to look at their own financials to see how they want to split that particular profit and come to a conclusion. In this particular situation, they said that, let's see how much was involved in terms of functions. Similarly, they have to make their own decision whether they want to split in terms of functions performed, or what are the assets that were used, or what was the risk that was assumed by them. It just depends on their own facts and circumstances. So that's really the profit split method. It depends. There's a subjectivity involved in terms of the profit split percentage is to be used, or how the returns are going to be between independent enterprises, etc. It just depends on whatever is the market data which is basically available. But in profit split method, all that you have to remember is that this is for transactions which are interrelated, for intangible transactions, and then a profit split is actually involved. This is the summary of the profit split method. You can just read through this and then say you have to find out the combined profit from that particular project and then split it with reference to what the parties are basically doing. The last method that we have is going to be something called other method. Now, other method, I want to tell you before I move to this, that other method is not there in any other regulations. It's not there in international guidelines, but India has something called other method. India has introduced a sixth method. Generally, there are 5 methods in transfer pricing. So India has introduced a sixth method, which is also called other method. Now, a lot of times, other method basically means that, if you want to substantiate, this is very similar to CUP, but still very, very different. So other method says that, the price which is charged by independent parties or the price which would have been charged by independent parties can be used in other method, meaning to say that, maybe you have a situation where you do not have a comparable party situation. In this particular situation, there was an independent party available and you were able to replicate this price as the ALP. But in a lot of situations, this ALP price is, not available. You do not have an independent party. Well, then other method, they say, can actually be used if you're able to find out third-party quotations, or if you're able to find out, valuation reports or some other document to say that if this transaction had been undertaken, it would have been undertaken at this particular price. If you're able to get this quotation from independent parties, then you can use other method. So you can say that if independent parties were also transacting, they would have charged this particular price. If you're able to get that quotation, third party quotation, then you can use this price as the arm's length price. But the point is that we do not generally use other method in transfer pricing unless it is a transaction which is more like reimbursement transaction, because in reimbursement transaction you can produce bills or receivables or payables kind of transactions. But otherwise, you have to move between CUP or CPM, RPM, TNMM method. Those are very widely used practically. The point is that, because we have discussed so many methods, the thing is which method is to be used when, and this is where the application of methods come into play. So which method is to be used when? I have developed this small table here, which you can use to see which method is to be used when. Let's talk about CUP method. If it is any transaction, as long as information is available to you guys on CUP method, if you have information on, the independent companies, if you have information on how much price or, the independent companies are charging, generally we do not have that information because it is a information which is confidential between independent parties. But if you have that agreement, if you have that information available, then you can use CUP method. RPM method is used for distributors where not much value addition is there. CPM is used for manufacturers. TNMM can also be used for manufacturing, but then you will have to see that information was not available here. So you have to reject the CPM method when you are using TNMM method. The first thing for manufacturer, maybe use the CPM method, the cost plus method, and then use the TNMM method. TNMM is easier to use because it talks about net profit. And PSM is when transactions are very, very related to each other, where there are unique intangibles. So whenever you're given a case study, you'll have to see, sometimes the question will talk about which method to use, but if the question does not talk about the method, then you will have to see the information which is given in the question and then make a decision. If the question squarely talks about manufacturers, then you know that you need to use cost plus method. If it says distributors, then you need to introduce resale price method. If the question talks about CUP, that independent parties are dealing at this particular transaction in this particular price, then you know that you need to use CUP. If the question has given you information to calculate the net profit, then you know that you need to use the Tnmm method. So it depends on questions. It depends on what information is available, not just in questions, but in practical scenarios also. So what I've done is, this is, what it basically says, that the most appropriate method is going to be the one which is suited to the facts and circumstances of each particular transaction. And this is how you basically find out which method is to be used when. It depends on what is the kind of transaction. It depends on what is the availability of data. If you do not have data available for CUP, you will have to use some other method. Then is it better to make adjustments? So if cost plus method requires a lot of adjustments, then you should instead use some other method, because the more adjustments, the more technical it's going to get. So might as well use a TNMM if a cost plus method requires a lot of adjustment. And then what are the assumptions to be used? What is the degree of comparability between the two transactions? So it depends on a lot of subjective things and a lot of technicality things on which method is to be used when. Okay. Any questions here? Please let me know if I need to explain, any of, we're done with the methods. And now we'll start with something called benchmarking analysis. This is going to be very, very interesting. I'm going to give you some practical insights on how we actually find out comparable companies in the industry. But before that, before we move to benchmarking analysis, if you have any questions relating to the methods, please let me know. Please put it in the chat box. I'll answer those questions. I know the methods are, it can get very, very technical, but that's where you'll have to practice questions. We will also practice a few questions towards the end of the next lecture on, all the transfer pricing concepts. I will also give you, what are the kind of questions that are asked, etc. We'll discuss those then. But, you'll have to practice all the methods. Okay, great. Thank you so much. Now we'll go to something called benchmarking analysis. What is the meaning of benchmarking analysis? It's such a technical word in transfer pricing. No, it's not technical. It just means what is the process of identifying comparables? How do you identify comparable companies? So all this while I've been just saying that, you have to find out comparable companies in the industry. You'll have to find out independent parties in the industry who are operating under comparable circumstances. So how do you find out these comparable companies? That entire process is called benchmarking analysis. And this is what I've provided in the slide here. So benchmarking analysis basically is the process of finding comparables or comparable companies, and this will help you in establishing whether your transaction is at arm's length or not. It involves search for comparables, and this helps in substantiating the tested party's international transaction or specified domestic transaction. What is specified domestic transaction? What is specified domestic transaction? If you can just put it in the chat box. SDTs. We discussed it very, very briefly in the last lecture. I'm going to discuss this again in detail in the next lecture. But what exactly is SDTs? Well, yes, exactly. The Specified domestic transactions was this domestic transfer pricing, that transfer pricing is applicable domestically also, that is basically called SDTs. So benchmarking analysis is basically how you basically find out comparable companies in the industry. Before we go to the entire process of benchmarking analysis, this is how you basically find out comparable companies in the industry. It's a very, very exciting process. It's not very elaborate. It's very, very interesting process. Let's take a minute. I've got some requests to actually display the slide on which method when. This is the one. Let's take 1 minute, go back to this particular slide, which method when, and then we'll discuss benchmarking analysis. If you're making notes, I must tell you that just tonight, just after we finish the lecture, I will upload the slides onto the portal. So you can download it from there, and all the information, all the slides will be available to you. This particular table and a lot of things in the slides is not available in the ICAI study manual. You can go through the slides, for that, just helps. And this was the other method of which method when. Let's take 1 minute on this slide. You can take notes, and then we can go to the next, which is benchmarking analysis. Okay, shall I move forward? Please, if you can write a yes, I'll move forward to benchmarking analysis. Okay. So we were discussing this table on what exactly is benchmarking analysis. How do you do benchmarking? How do you find out comparable companies in the industry? Well, if you see, the Indian law, if you see the transfer pricing regulations in India, it does not say that this is how you need to find out comparable companies. It just says find out comparable companies. It does not give you, like a procedure like that I've given out here. It just says that you have to find out comparable companies. But what we do is we look at, various decisions of the judicial authority, Supreme Court decision, High Court decisions, tribunals, etc. We look at all these decisions. Then there's a lot of guidelines which is provided, which is the data in the public domain. We put them all together, and this is how we find out comparable companies. So what I'm really trying to say is that it's not available in the guidelines. It's just a process that we've established by using the guidance which is provided in different case laws and given by decisions of the judicial authorities. So how do we calculate it? Well, the first thing that we do is look for a database. As I mentioned, there is something called a transfer pricing software or a transfer pricing database, etc. Second thing, we look at the industry. Then there are some quantitative filters that we apply. Then there are some qualitative filters that we apply. Then we do some analysis. And finally, we document everything that we've done. When I say document, we write it somewhere that this is how we actually have found out comparable companies. So this is how we select a database. So the first step in the entire process is to find out which transfer pricing software or which database. What exactly is this transfer pricing database? Well, a transfer pricing database is like a database wherein all the companies, private, public companies, which are operating, say, for example, in India, all the information on these companies are actually provided there. So these databases are private companies, and these databases are held by private companies. And what they actually do is they have information on several companies, about 38,000 companies, or 42,000 companies. They have information on all these companies, and that is, they are just provided, the information is provided in a very, very detailed and organized manner. So there are a lot of transfer pricing databases, or there are a lot of transfer pricing softwares which are available in the market. Each one has their own advantages, their own disadvantages, etc. And what you can do is, if you're, because you need to find out comparable companies. So if your client or your company is actually manufacturer of pen, then what you can do is go to the database. It has 38,000 companies, and you can put filters out there, that I want a company which is in manufacturing, then I want a company which is in the industry of pens, manufacturing stationery or manufacturing pens, and then it will filter all these companies to a few limited companies. So that is how you basically put a lot of filters, and then you're able to find out different companies. I'm going to display a particular database right here, but this is how you basically, do it. So database is uh, a place, a domain where information on all these companies that are operating in India are, present. So the point is, if you look at, the databases in the market, there are different transfer pricing databases available. They're just private, databases, and you can take whichever database that you want. So, you can take a Prowess IQ, you can take a Capital Line, you can take ASTP, you can take OneSource, you can take Amadeus, Royalty Stat, CompuStat, etc. They're just like those, softwares. You can use, you can use CompuStat. For income tax returns, you can use a CompuStat. You can use, say, for example, Genius, or any private basically databases. So like the same manner, we have transfer pricing databases also. You can take any databases. They're very, very competitive between each other. They have a lot of companies, all of them. So now, after you have made a selection on, the database, this is how it basically looks. This is an example of how Prowess, really looks. So if you look at this particular figure out here, okay. So if you look at this particular, figure out here, it says that you need to find out companies. Now, my company that I need to find out is my client, or my related party is a banking company. So what I'll do is I'll go to the Prowess database, and within all industries, because I want companies in all industries, I will select banking services. And that is because my related party is in banking service industry. So what I'll do is, I will select here banking service. Then it will give me a list of all the companies in India, say for example, which are under banking business. So it has given me about 207 companies. What I'll do is, I'll make a list of all these 207 companies. You can also export this list. There's a option here. You can export it into Excel sheet and make all those calculations. So, but now it has given you 207 companies. Now, within 207 companies, I want to use Tnmm, and I want to calculate the profit margin of these companies. So because I feel that all these companies are, similar, doing similar work, they're comparable to me. So I need to find out the profit margin of these companies. So what I'll do is, I'll go back to the software, and I'll say that for those 207 companies, I want audited financial statements. If I have the audited financial statements, I can calculate the profit margin very easily, because what I'll do is, I'll calculate the operating profit, I'll divide it by, sales. So I'll get all the information. So I say audited financial statements. After I do audited financial statements, it's going to give me the option that, how do you want to calculate operating margin? Well, I'll say I need sales. I need, other income. I need total expenses. I need, total assets. I need foreign exchange transactions. Whatever you need to calculate, that particular profit margin, you're going to say that. So what it'll do is, for these 207 companies, it's going to give you the, if you see the sales figure, sorry. It's going to give you the sales figure. It's going to give you total expenses. Then for the next year also, it says 1998 because, it's a old screenshot. So it's going to say that for these particular 207 companies, this is the sales, this is the total expenses. Then for the third year also, it's going to give you sales and total expenses. Whichever year that you want to use, you can, choose. And then it's going to give you sales and total expenses figure, whatever figure that you want. And then you can calculate the profit margin of these 207 companies. Now, the point is that how do you filter it down more? Because I can't compare my company to 207 companies. So then that is where you have to adopt something called qualitative filters and quantitative filters. So what I'm going to do is there is a two filtration process that I will adopt on these 207 companies. So I will tell the database that, listen, I want to adopt something called quantitative filter. That basically means that only for companies for which sales figure is given, only give me that information. A lot of times, in these softwares, it happens that the sales figure is not given for all the companies, or say, for example, the expenses figure is not given for all the companies. So then you tell the software that, you filter it down and you say that only companies for which information is actually given, give me information on only those particular companies. So what happens is, if you see in this particular situation, the sales figure is not given for the second company. This particular company, the sales figure and the total expenses figure is not available. So the company will actually, the software will delete this particular company. Then if you see this particular, situation here, which is the sixth one, the sales figure is not given, the expenses figure is given. It does not help me that way. So this will delete that particular company. So I will adopt a quantitative filter, which will basically say that, sales greater than zero will be actually accepted. So only companies for which sales is given will actually be filtered down. Then other quantitative filters that I can adopt is availability of financial data, revenue from main business activity, turnover filter. What the turnover filter will do is, if I have my client which is earning a 500 crore turnover, I would also want to compare it with other companies in the industry which are earning 500 crore turnover, or something which is similar. Generally 10% here and there is fine, but I would want to actually compare it with companies who are also earning the same turnover, right? So I will tell the software that, listen, I want to adopt a filter which is turnover near 10% is actually allowed. Beyond that, or less than, will not be allowed. So the software will reject those particular companies. Then I will also tell the cost software that if it is a consistent loss making company, then delete that also, because I don't want, my client has not been making losses consistently. So delete those companies also. So this is the reason why when I put in quantitative filters, the number of companies will actually come down. So let's say the number of companies have come down to 100 now from 207. Now what I'll do is I will look at the financial statement. I will just make a Google search, or we generally use different softwares for search. We take out the annual report of the company, and then we manually try to check for these 100 companies, whether it is the same as me, whether it is actually manufacturing a pen and a ballpoint pen like I do. So, the software will tell you that it manufactures it manufactures a pen, but it will not go to the extent of telling you that it manufactures a ballpoint pen. So for that, you will have to look at the annual statement. So when I was, in my initial years of my career, we used to actually use these softwares. And when I did my search, the number of companies that I got were actually, 10,000 companies, something around that. And I remember after using all the quantitative filters, the company came down to about 3,000 companies. And then I had, spent about a lot of days in terms of taking out the annual report, or finding out on the company's website, etc., for all those 3,000 companies, whether they were comparable to us or not. That is the kind of exercise that you need to do in terms of coming down on the number of companies. And finally, let's say that after this entire exercise, we've come down to, say, for example, 11 companies, 11 comparable companies for our transaction. So our transaction, my client, had a profit margin of 15%, and now I have profit margin of 11 companies, and I can't filter it down to lesser number of companies. I somehow feel that all these 11 companies are comparable to my company. Now, what is the next step that we do? That is what I'm going to explain. But did you understand till here? Please, if you uh, please let me know if you've understood till here that I found out 11 companies. Is this much clear? Yes, filters are, more like conditions. All the filtration, you do that in Excel sheet. So, in Excel sheet, what we used to do is to have these big, big conditions. Um, and the Excel should, when we have these conditions in Excel, it used to delete the companies and, filter it out for us. So they're more like conditions. And, again, it's a subjective process because, we used turnover filter and consistent loss making filters, but other people might not, do that. So these are very basic filters. Everyone should do it. But then again, it's a very subjective thing. So in the entire process of filtration of companies, it's a very, very subjective exercise. It requires art and skill and, uh, it just depends on facts and circumstances. So now the thing is, I've come down to 11 companies. Now, if you see, in this situation also, the software gave me 3 years. Now the point is, do you have to use 1 year or can you use multiple year? Well, there was a time that the Indian laws said that you can use just 1 year. You have to use just the current year. So you'll have to see what is the transaction. If this transaction relates to financial year 22-23, make sure that the comparable companies also have transactions in 22-23. But what happened was, if you look at transfer pricing returns, they go in November, and the other returns, for MCA, you have to put the financials in October, say for example. So there's a lot of discrepancy because this current year information on the comparable companies was not available in the software. So current year data was basically not available. So what they did was the CBDT came up with an amendment, and they said that if you entered into a transaction after 1st April 2014, then you can take multiple year data also. So generally, data that you need to use for comparability is going to be the financial year, the same year that your transaction has entered into. But they somehow say that current year data might not be available. Current year data, you cannot see anything for current year data. It might be distorted, etc. So they said that you can actually use data of up to 2 years. But for that, they have a few conditions. This 2 year data, which is multiple year data, it can actually be used only for RPM, which is resale price method, Tnmm, or cost plus method. Otherwise, this cannot be used. Otherwise, you have to use current year data. But then if you're using these three methods, then you can actually use multiple year data, which is going to be the current year data, and then it's going to be data of 1 year before that, before the current year. And then, you'll have to actually average it out and then see what exactly is, the profit percentage. So what you need to do is, if you're using multiple year data, you'll have to average it out accordingly. So this is the data which is to be used in analyzing comparability. The last thing that Indian tax authorities did was, initially, now imagine that I've got 11 comparable companies, right? So after I did all the entire exercising on filtering the company, etc., I got 11 comparable companies. Now I need to compare my client margin to only one margin. Now how do I do that? Well, that is where Indian tax authorities said that what you can do is you can calculate something called an arithmetic mean, or you can calculate something called a range, an interquartile range. So Indian tax authorities say that if you have comparable companies less than 6, then what you need to do is calculate the calculate the arithmetic mean. So I've got 5 companies. Calculate arithmetic mean of those 5 companies, and then compare your client margin to that arithmetic mean. If it is comparable, if you are that particular range, or if you're more than arithmetic mean, then you are at ALP. Otherwise, Indian tax authority said that if you are, if you have comparable companies which are more than 6, then you need to use something called an interquartile range. The interquartile range that we follow in India is that you have to find out the 35th percentile and you have to find out the 65th percentile. So what you do is, if you have 6 or more comparables, and in my example, we have 11 comparables. So I'll have to list down those 11 comparables, and then I have to find out the range, the 35th percentile and the 65th percentile of that particular data set of that particular 11 comparables. If my client margin is within that, then I am at ALP. Just as an example, this is how you calculate the range. So what you do is, let's say if I have 11 comparables, what I'm going to do is I will have to arrange them, in ascending order. So what I'll do is, if one comparable company has a margin of 3%, 6%, then 18%, then 20%. So I'll have to arrange them in a comparable, in an ascending order, all the 11 comparable companies. Then what I'll have to do is calculate the 35th percentile and the 65th percentile in that particular range. Now, if my client margin falls in that particular range, then I am at ALP. As an example, let's say that, my client margin is 7%. And I have found 11 comparable companies. The 35th percentile is 5%. The 65th percentile is 10%. That means my client margin of 7% falls in the range of 5 to 10%. That basically means that I am at arm's length price. In situation where, my comparable companies are 5, then I need to use arithmetic mean. So if my client margin is 5% and the arithmetic mean, comes to, say, for example, 2%, then I am at arm's length price because my margin is greater than the arithmetic mean. It should always be, your margin should be greater than or equal to the arithmetic mean, or it should lie between that particular range. So that is how you basically apply the range method in transfer pricing. So go through this, go through multiple year data and range. These were, amendments that were made to Indian transfer pricing to just make it in sync with global best practices. These 2 things, and as long as it's in range, it's at arm's length. Please let me know if you have any questions. Till the time you do not have any questions, I'm going to quickly take a request to explain, the RPM method again, which is the resale price method. Meanwhile, while I'm explaining the resale price method, if you have any questions, just put it on the chat box and I will answer those as well. Okay, so now what we have is something called the resale price method. The resale price method basically says that, there is a parent entity and then it is selling to the subsidiary company, and the subsidiary company is reselling it to the end customer. So the situation is that there is a parent company. It is selling something to the subsidiary company, and the subsidiary company is more like a distributor. It does not do anything. It does not, value add in this particular commodity. It does not make any value addition. Just as it is, whatever they've received, they just sell it to the end customer. But obviously, there is a margin. So in resale price method, let's say that there is a parent company, it is selling to the subsidiary company and it is selling at 75 rupees. Now the subsidiary company sells it to the end customer at 100 rupees. That basically means that if you look at the subsidiary company, it has made a profit of 25 rupees in this transaction. What you need to do is substantiate that the transaction between the parent company and the subsidiary company is at arm's length. How do you substantiate that 75 rupees is at arm's length? Well, that is where you can substantiate it by saying that resale price minus if there was an arm's length margin, that means that 75 is at arm's length. So if you can substantiate that 100 minus 25 is at arm's length. So if you can substantiate the 25% that this subsidiary company made in this particular transaction, if you can substantiate that this is at arm's length, then you can tell that the entire transaction was at arm's length. So you need to substantiate that the subsidiary company made a profit of 25%. You need to substantiate that this resale price margin or this resale margin that was made by the subsidiary company, this 25% was at arm's length. So how do you do that? Well, you find out related parties and you find out that they were also making a margin of 25% or lesser than that. So in this particular situation, what happened was, so in this particular situation, in this particular example, we had the resale price and we need to minus the profit margin. So in this particular situation also, we have the resale price 100 minus we need to deduct the arm's length margin, and then we'll come up to this particular price, which is what is the correct price. Is 75 correct or not? Because this is where we need to substantiate this is at arm's length. So what we'll do is 100 resale price minus an arm's length margin. So even in this question, we took the resale price, which was 20 crores, minus arm's length margin. When I say arm's length margin, which basically means that what is arm's length? What is independent enterprises? What is the margin that they are making? Well, in this particular question, independent enterprises were making a margin of 20%. So resale price minus arm's length margin, which is 20%. So this is the arm's length price that we have got. This is the transfer price, meaning to say 20 crore minus arm's length. And this is the price that we've got, transfer price. The transfer price, if we deduct arm's length margin, only then we'll get the transfer price. So even in this, resale price minus, we're going backwards, minus the margin. That means that this is the price at which independent enterprises were transacting at. But you'll get the arm's length price only when you've deducted an arm's length margin, what other people are getting. So this is the reason we get 16 crores here. And then whatever is the question asking for adjustments, you have to make those particular adjustments and you will get the final arm's length price here. Now the question is that the question says 20% is the arm's length margin, and these guys were actually charging 15% in related party situation. So if we had deducted 15% out here, it would have been wrong because 15% is not arm's length margin. We need to deduct arm's length margin from here, from the resale price, and only then we'll get the transfer price that would have happened. That was the correct arm's length price between sun and earth in this particular situation. So this is how you basically deal with resale price method. In resale price method, you first have to look at what you do is, if the question says resale price method, you first start with the resale price and then deduct the margin. If you deduct the margin, you will come at this particular price. But you have to deduct arm's length margin and then only you will come at arm's length price. Please let me know if it's better now. Guys, if you have any other question, please let me know. Otherwise, I know that this was very, very difficult. The methods were very, very difficult. It's okay. This will also pass. But if you have any question, please let me know. Otherwise, I'm going to see you on Monday and we'll discuss things relating to dispute resolution when it comes to transfer pricing. So we'll discuss advance price agreements, we'll discuss safe harbor rules, etc. But I'm here if you have any questions. Yes, it's correct. Thank you so much, guys. Um, there's a question here. I will also address this question when we discuss, tomorrow the TPO cases and the dispute resolution, etc. But for now, thank you so much. See you on Monday. Thank you. Please let me know if you enjoyed the lecture. Thank you. Thank you so much. हाँ जी